Hey, Abhinav. Good afternoon. Retiring the stock market session one, November 24th, 2024. How are you?
I'm great, sir. How are you?
Pretty good.
Thank you.
I have Chipotle behind me. I wanted to show you. It's
Yeah.
probably my second favorite stock. Um, it was only $13 10 years ago. This is 10-year chart. 10-year chart is a good indicator of success. And so if it's 6201 now, right, and it was 1327 10 years ago, what you do is just take the math, 6201 divided by 1327, and you get like what, like fivefold return.
Yeah.
Do you have a calculator? We can do that now.
Yeah. 6201 divided by 13,
27.
27. We're looking at 4.67. So we move the decimal, right?
No, just we're not doing a percentage. We're just doing multiples. Four,
Oh, yeah.
between 4 and 5 times return.
Yeah, almost five times, 4.67. So
So
almost five.
like this is the example of a great stock. Most stocks won't do this. So this is uh selecting these creams of the crop, these gems that are out there. A lot of it is about performance. If you perform great in the last 10 years, chances are you're going to continue to do that.
Yeah. And it's a food company. It's got a lot of utility. I know I used to eat a lot of Chipotle. I think this is after the split because they were over $1,000, right? If I remember correctly, or multiple thousands of dollars.
Yeah, good point. Chipotle was never $13. It shows $13. It was never $13. Why it shows that is because of the stock split. It had a 50 for one. So it was 3,000 per share. Divided by 50, it comes down to about $60 a share.
Mm,
So because of the stock splits, the historical prices will not be exact, but they'll be in the correct perspective.
yeah.
Because some people will say, "Oh, I bought Microsoft at 11 cents." That's because that's what it was. I think coming out of the gate, it's about $20, but 11 cents because of all the stock splits. They have to um, readjust the share price on the chart because of the stock splits. So even though it shows 11 cents on Microsoft, which is an all-time record, 3,500 return on Microsoft, 3,500 to one return. It's going to show about either 11 cents or 7 cents. I don't know what it is by now, but and the stock is 400 and something now. So it's reflecting the 11 cents because of all the stock splits. And that's another criteria that I want you to really get behind is selecting stocks that has stock splits, because those are the ones that are great because they've gone up and up and up and up. And the price is so high that the board of directors decides, let's let the stock down, get more investors interested,
Mhm.
look like a more attractive share price. Chipotle was 3,000 a share. You have to have 300K to do a cover call on that. So that's very hard. So bringing it down to 6,000, 60, then now you only need 6,000 to do a cover call. You see the big difference?
Yeah, yeah.
So, anyways, and Chipotle has some of this stuff I like. Volume, 9 million per day. You see right on the bottom, PE, 57. It has PE showing a profit. Market cap, 84 billion. 84 billion is a great market cap area because it's not too small, but it's not too big.
Hmm.
Um, they're planning on opening another 500 stores. So this $60 will go to 120, and then to double again to 240, maybe in the next 5 to 10 years.
Got
And
it.
then average volume, well, that's the same as volume, but um, has a 52 high and low. Look at that. Okay, so any questions on that?
No, makes sense.
And Chipotle isn't a great return as far as the cover call. It just gives like 2.5% or three
Hmm.
percent. Let's say 3% on a good day, right? But the share growth is good, so it's going to go up over time. And I like the company. Like you said, you used to buy Chipotle. I still go to Chipotle. Uh, the feeling on it was like it's the organic McDonald's. You know, so the McDonald's that's a little more healthy.
Yeah, when I used to be a bodybuilder, this was like something I ate multiple times a week. It was the only place you could go get grilled chicken and rice before they made it all extra buttery and oily.
Nice, nice. Also, I remember they used to have chips made in oil. Now the chips are made just from in a dry fryer.
Yeah, yeah, yeah. I remember that.
Okay, cool. So you get the concept. Great. Okay, now you had two questions for me. First of all, I want to say that um, I appreciate you because you got a hold of my core and my YouTube and my TikTok. So you kind of a few steps ahead of the game. I think that's going to help you in these in this course or taking my course because you kind of got a feeling of what we're going to talk about, and I think you're on board already. I'm not going to have to convince you. I'm not
No,
going to have to teach you
I'm sold.
math.
I'm here.
You know the math. I mean, some people will pay me the money and be like, "What are you talking about? This is nonsense. What are you talking about?" You know, and then they'll argue with me. You know,
Yeah.
so yeah, so it's a lot of it is perspective. Like if you find something that you can work with, then work with that. You know, these certain things. I'm going to show you from A to Z what I do, and it's not difficult. It's pretty simple. Okay, and that's the problem that we're going to have is that if it's so simple that it's simple not to do it. It's easy to do it, and it's easy not to do it. You're going to notice there's no really advanced, complicated trades we're going to do. Most of it is like philosophy, principle, and just applying what we learned, basic math.
Right.
Different reasons we do stuff, different stock selection, but nothing that you can't learn over time. Um, Nothing. There is no secrets. The secrets is applying the basic principles and being consistent.
Yeah.
There's a saying in the Indian from India, a scholar. There's a scholarly saying. It goes something like this: to do, no, to know and not to do is not to know. Which is to say that you can know something, but if you don't really do it, you don't really know it. So you can know something on paper, the textbook answer, you've talked about it, you heard about it, but if you're not really doing it, you don't really know about it. And that's the situation here. We're specializing on cover calls. We're specializing on paying your bills monthly to retire the stock market. We're specializing in philosophies and diversification of your portfolio to where you're gonna be good either way. If you do these trades correctly, you're gonna get to the point where you can't lose.
Hmm.
And that might sound like, like a pipe dream to some people. They'd be like, "What are you talking about? What is this? What is that? What if this happens? What if that happens?" So you can always like find faults and stuff. What I want you to do is look at the things that you can go with and then try them out and get the result. Even if you're not sure about it, try it out, learn it, get the result, and then you'll have your results. But if you try to put your own do your own thing, I don't think you're going to get the correct result because I teach it different. I have different strategies, and whatever you learned up to now, I just want you to forget it. Just throw it out because I want to teach you fresh from scratch. I don't want you to have to. I want to have you unlearn what you have learned. I want you to just a clean slate, one thing at a time, apply, get the result, and that's it.
Got it.
How does that sound?
Sounds great. The reason why I wanted to do this quickly is because I learned the best when I'm in an immersive situation, and that was the reason I asked you, like, do we have to spread these out over, several months? Because right now when I have the time off from work, it's best for me to be immersed in the knowledge, practice it, ask you questions, and like kind of really just get the time to digest it rather than spread it out too long. And as you can tell, I'm not someone that um, is here just for, shits and giggles, really. Like I'm taking this seriously. I'm gonna be on top of it. I'm a professional at work, right? Like I'm a business professional, so this is important to me to learn this skill set.
Okay, great. Great, great. And you had some questions for me. Go ahead.
Yeah, so the first question I had based on our prior discussion and like as I'm looking at these options tables and I'm trying to see like okay, for example, let's say I pick Tesla or any stock. If I'm looking at the current price of the stock and I want to buy those shares, let's say I'm buying 100 shares at current price, what is the like formula or the method for picking how many points above the strike price should be, like from the current price? What's like, how do you determine the delta? Like, is there a formula for this? Is there some kind of right way of picking versus like a smaller cap stock like IonQ versus Tesla? Are you looking at average ranges of those stocks, or how does one person determine like, or are you looking at just the premiums? Like, okay, what can I get the most money for? Is that the way to go?
You're jumping right into the covered call. That's good. So you buy 100 shares, right?
Yeah.
Write the cover call now. If you know, probably know. Each stock has like 1,000 options. The ones that have weeklies have like 1,000 options. I'm going to show you the exact one. The best one is going to get you the correct return monthly for the ideal situation, for the ideal return, for the ideal share growth. Okay, and that is what's called the sweet spot, right, John? Sweet spot.
Sweet spot.
So you mentioned Tesla. Do you want to look at Tesla
Yeah,
or
let's do Tesla because it's top of mind. And I
so
did
give me the okay, it's TSLA.
TSLA.
Give me the price Friday, and then also
Current-
the change Friday was up what?
Yeah, so the price of closing on Friday, 1 second, was 352.56, and the percent change was 3.80.
No, no, I need the dollar amount.
Yeah, $352.56 is the closing price.
No, I need the dollar amount of the change
Oh, $12.92. I see what you're saying.
plus 12.92.
Yes.
Now it won't always be up $12 a day, but that was just a decent day for Tesla.
Yeah.
When it's down $12, don't trip out. Okay. All right. So on this one, and all the stocks are the same. The sweet spot is giving you both share growth and premium. Okay. Because why? Because the basic procedure for a cover call is only to agree to sell your shares at a later price at a later date to get a premium. Okay. That sounds kind of weird. Why would you get paid for that, right? But you get paid by the option buyers. So when you have the shares and you sell the option, you're creating the option because there has to be shares before there's options, right?
Hmm.
Because options apply indicate shares. So we own it. We buy the shares. Let's say at the market price. That's the best. I mean, that's the simplest way. Just buy the market price. Ideally, you want to buy your stock on a dip, or you want to put a limit order to get a little bit better price. But for all intents and purposes, just buy it at the market. And then you're going to write the cover call, which is agree to sell the shares at a higher price. My system is a higher price. And that price is going to be the sweet spot. So we're going to get to strike, which means we agree to sell at the strike, where the premium you're getting is the same amount as the share growth from the stock price to the strike. For example, 352, okay, let's say 353 because it's almost 350. Oh, 352.50. Okay. So if we go to 360, that's going to be 750 share growth. If we go to 370, that's going to be 1750 share growth. You
Yeah.
understand now? Between 352.56, which is the current share price, to 370, which will be the strike, is 1750 share growth. You understand?
Yep.
So look at the premium now that they're paying for December. Let's just say, well, we're almost going to be the following week. So let's just do the 27th. It's probably closer to a month.
Yeah. So let me pull up
First,
the.
actually, let's do this. What is it paying for December 20th? And what is it paying for December 27th on the
Yeah,
370?
pulling it up. I while this loading, I did do the math real quick on this one trade of buying it, let's say at 355, selling a covered call at 375. But this was not for December. This was for January 17th, and the premium was $26.15. So it was a 7.3% return. And if your shares do get sold at that price, you would then get another $2,000 on top of that from share growth. Now I'm looking up for December 20th here. The three,
That's correct, but that's correct, but that's just a little bit farther out than I like to do it. I like to go monthly, and if you want to write it down, I like to go write down 3 to 7 weeks out for the CC. So 3 weeks would be the December 20th. 7 weeks would be in January, but for now we're gonna do December 27th. Okay.
yeah, so I have the prices for us. So December, I'll tell you both. So 370 strike for December 20th, selling a covered call is $17.85. And the same strike 370 for December 27th is $19.75.
Now on December 27th, is there what's the strike above 370? Does it go 5?
Yeah, 375
How
is at
much is how much is 375?
375 is a hair shorter, so it's $18.25 versus 19.75.
Okay. Do you see how they're giving you a lot more share growth? They're giving you 5 more points of share growth, and you're only taking $1.50 less a premium.
Yeah. Yeah, you're getting like
That's
500.
a great scale because it's showing you that, if you're willing to stick with the stock more and look at that share growth, you're gonna end up getting paid a lot more. Whereas if you want to go with the premium, you cut your share growth, you get a lot less. However, the premium is going to be going in your account right away, like in your pocket. You can pay your bills with that. You can write a check with that. $1,800, $1,900. So the sweet spot is going to be the 370 strike. Whether you're doing it for the 20th for 1780, the 20th for 1785, or you're doing it for the 27th, 1975, because that's the closest strike where the premium equals the distance between the stock price, 352.56, counting up to the strike, which is 17.5 points.
So just to understand, you're saying that
Sweet spot, SP sweet spot.
yeah, SS, the sweet spot. uh,
Actually, right. SS.
the sweet spot was where the premium you're collecting is equal to or greater than the stock growth you would get at if your stock sold at that strike price from the purchase price.
Exactly. And ideally, to qualify for a cover call position, it needs to pay 3% to 5% per month. So let's do the math on Tesla for the December 27th. 1975, 19.75, and then divided by 352.56. Can we do that?
Yeah, so we're looking at 0.056. So moving the decimal, you're looking at about 5.6%.
Wait a minute. Give me the number after the 5.6.
It's 0.
Great. Okay, so we move it twice. So 5.6% return.
Yeah.
Now, we could get a 7% return. We can write the cover call at the money, 350. Let's say 360. What is 360 paying?
Okay, for December 27th week, 360 is actually paying significantly more. It's paying $23.50.
So we could get a higher return if we want to agree to sell the shares at 360. But let me give you my experience, can I?
Absolutely, sir.
We're already betting these stocks. These stocks are great stocks. They're probably going to go higher. If you look at the long-term trend,
Totally.
like the one behind me, over the long term, it's going up because it's a great stock and it's hot and it's popular and they're doing stuff right. They have PE, they have a certain appeal to investors. So we want to definitely allow for some share growth. And my experience is because the stock will dip sometimes, Abhinav,
Yes.
um, we also needed to be able to swing up to balance off that dip that we're going to definitely incur at some point. So the problem with the standard cover call is the stock can go down and lose value, but the cover call amount is gonna be there, whatever it is. Let's say 5%. But you don't allow the stock to go up if you write the cover call too close to the strike price. So if you allow for the upside going up and also the downside, that allows a longer term better average. That's why the sweet spot is the best because you're allowing for share growth to the upside. In this case, 17 points. You're allowing for it. Well, there's no choice. If it goes lower, we have to lose some share value. Meanwhile, for agreeing to sell the shares at 370 at that sweet spot, we're going to be paid 19.75 per share or $1,975 for 100 shares, which is one contract, and with a total investment of $33,520 $25.
So just to clarify, how did you come up with picking the 370 over the 360 as the sweet spot? Um, because the 370 is giving us 5.6%, but the 360 is giving us 6.66%. Um, I guess maybe I'm not fast enough on the math here, but like the share growth on the 370 is obviously a lot higher. It's like 17 and a half points. But on the 360, it's only like 7 points.
So the 370 is more desirable because that's the sweet spot where the premium, in this case $19,
Yeah,
$20, is closest to the share growth potential,
it's
which
right. So it's
is
$19
in
versus
the
70.
350,
Ah,
352 to 370.
got it.
If you do the 360, you only have 7.5 points in the share growth, and you have 20 points or whatever, 23 points on the premium. So it's not balanced. You want to balance both.
Okay, you want it as tight as possible. So in
You
the
want to balance
370,
both. Yeah, as tight as possible.
right. So in the 70, you're getting about 19 points of premium and you're getting about 17 points of
17.
share point.
Actually, it's 1750.
Right. 1750 of share growth and 1975 of premium. So it's very close. It's about $2 apart
If
versus
you did, if you did December 20th, it's actually 1785 premium, and then 1750 share goal, which is actually almost like the perfect sweet spot. And that's probably a better one to write because it's going to keep you on the monthly. And we start getting on the weekly, there comes more mental gymnastics. So it's better to do the December 20th if you have to pick, because that way I know you can do. Once you do that one, that one's over. You can do January 20th, February 20th, March, etc. But when you start getting on the weeklies, you start getting off course, and it's more difficult to come back. But
can you
yes, whether it's the 20th or the 27th, the sweet spot would be the 370 strike.
Can you just explain like why you I'm not like challenging you, but just to understand like why is it that the weekly is not a good idea here? Because if you are someone that's willing to maybe do more trades, why would the weekly, even though it's closer in expiration, not be a good call? Is it just because the math isn't there, or is there some other reason?
It's more difficult. Well, hang on. Are you saying the weekly as in writing every month, but the weekly? Or are you saying the weekly as in doing cover calls every week?
Yeah, so the second. So like for example, if we instead of picking December 20th, we pick 20 November 29th. Um, and we're looking at the 370 right now. The 370 strike for December.
Okay, it's because, okay, this is why. Like when you're teaching, you want it to be duplicatable. Okay. And like one thing you can do, if you become a great trader, you can also become a great mentor, and you can teach this stuff like I'm doing. And you're going to realize that the more complicated it gets, the harder it is to teach it.
Yeah, of
The
course.
person, the student's not going to do it.
Yeah.
So if you're doing cover calls, first of all, there's two answers I want to give you. The first answer is stay on the monthly because the monthly has more volume. Okay,
More volume.
that indicates a tighter spread to the bid ask. And that way, if you trade that cover call, if you have to get in, get out, buy it, sell it, you're gonna get a better price on the whole. So where the December 20th may have X volume, December 27th may have a lot less volume, and you're gonna get a less return because of that, and it's gonna be harder to trade it. So that's just a better.
Okay, that's fair.
That's a better week to do the monthly.
Yeah. No, that makes sense because I was just thinking in my head, and probably what anybody else would think, like, the greedy mindset would be, well, why wouldn't I just sell weekly and just collect $400 every week than trying to collect $2,000 and then have to wait a month, lock up my shares, not be able to do anything for a month. But now it makes sense, like there's a
Well,
risk.
let me respond to that part. The second, and here's your second answer. There are people who do weekly cover calls. My experience is a lot of them aren't that successful, and I mean the rates of success. Like the success isn't as great as on the monthly. The reason is because there's more things that can go wrong with 4 trades as opposed to 1 trade. Okay,
That's fair.
and there's more work to do. Like when I tell you that I can teach you the entire stock market, I need it to be as simple as possible because the more work you have to do, the harder it's going to be to do it.
Right.
So it's easier to do longer term trades. It's harder to do shorter term trades, and it's most difficult to do a day trade. That's the most difficult trade because a day trade, for all intents and purposes, the stock can go up or down, and we have no way of knowing which way it's going to go. But if you do like a long term cover call, remember the IONQ?
Yep.
Going out 2 years.
Yeah.
So that's the easiest trade because all you're saying, listen, I'm going to do an investment. I'm going to buy a stock. IONQ for 30. IONQ is not the greatest choice, but this one has the highest return for $30. That's without an investment. And if I wait 2 years, 2.5 years, whatever it is, to how many 700 days, they're going to give me 16 points, which is 50% return. Okay. And that is 25% return for a year. And we only get average 10%, 12% return for the year on the S&P. So you're just doing one trade. You don't have to look at your phone. You don't have to take out. You can work. You can do stuff. You know.
Yeah.
Then you start going monthly as well. Now we're doing a monthly trade. Oh, by the way, only one thing can really go wrong during that time. The stock can go down, or if it goes up, there's no worries. If it stays the same, there's no worries. The stock can go down over 2. You have 2 years for the stock to maintain price. Okay. Now, if we do the monthlies, which is my choice, personally I think it's the best monthly. So I want you to start in the monthlies. You can later on if you get successful and we're doing the monthlies and you're consistent, you can jump to the weeklies, but it's going to be a lot harder. I'm telling you.
Yeah. No, I'm glad I asked. I just wanted to understand.
Now going to the weeklies, yes, you can make more money. Oh, by the way, the monthlies are designed that you're going to pay your monthly bill. Your bills come every month: mortgage, car note, gas, water, and power. So when you get paid that money, it's real easy. What I do, I just write checks to pay the bills from the. Did I go over a cover call trade with you where you're doing a cover call, then the money gets deposited in your account? You see your account cash go up. Have you seen that?
Not yet. No, I haven't.
When you do the cover call, you'll see your buying power and your cash available go up the moment you do the cover call. And you can write a check with that money. You can withdraw it, buy more shares, whatever you want to do. And this is again on the monthly system. It's better to pay your monthly bills, and that way you can get to the goal, which is retiring the stock market.
Got it.
And the weeklies, yes, you can get a higher return because you're getting, 4 times and maybe less every time, but more on the whole. There's more work, there's 4 trades, and what can happen is more things can go wrong. Hello?
Yeah, yeah, I'm here.
Sorry, I got a call. More things can go wrong. For example, a stock can go down, and now you're gonna lose share growth, and now you have to worry about where you're gonna if you're gonna do the next cover call, where, and if you waited a month, it could have at that time it could have went right back up, and you wouldn't have any share growth loss. Whereas if you go in weeklies, you could have it to where you can lose money on the share growth, having to have the right a lower cover call, losing more money again in the share growth, having to write another lower cover call, and then the stock goes right back up to where it was before, and you would have been better off just writing the monthly.
Yeah, and then you could have had your shares hauled away in those weekly covered calls at a loss.
Once, twice, 3 times, yes.
Yeah.
So more than can go wrong. I'm looking at a defensive. I'm looking at great defense. You want to be defensive when you're trading investing. You don't be too aggressive. So it's just easier to do it on the monthly.
Well, can I
And
just ask?
I want to make it easy. Actually, it's easy to do it on the 2 or 3 months, but the monthly is better to pay your monthly bills.
So if I may just ask, and especially if we post this, I'm sure someone's gonna really find this question helpful. Why is it that, and I've fallen trap to this. I told you this when I messaged you, like where, you end up looking at the technicals of a chart, let's say Tesla, and now you're seeing, okay, there's a lot of volume, there's momentum, it's really starting to break through resistances. And then you open up your account, you say, okay, I'm gonna buy just a 370 call, just a call, not a covered call. I'm just gonna buy a call, and you buy a weekly call or a 2 week out call. And then, things change, and all of a sudden you're seeing, oh shit, I'm down like 50% on this call. Should I wait? It might come back, it may not come back. But then why is it that that is kind of being advertised more and more, where I even see people posting trades where it seems like all they're doing is basically buying calls and puts, not covered calls and puts, but just open-ended calls and puts that expire on the specific day. And it seems like they I mean, the people that show their success tend to make money, but most people, and even from my experience, you lose money that way because all the Greeks are against you, the volatility is against you, the time is against you. But in this, so like I guess contrasting how all that stuff is working against you, but somehow people find a way to make money, or am I missing something? Like first off, how do they make money doing that? And second, for the covered calls, those Greeks, do they like work in your favor? It almost seems like they don't work against you because we haven't even talked about those, and do they even matter for us in these covered calls? So those are kind of my questions in the terms of contrast. They're like, why is that like super um, out there approach that as advertised so much, and people show that they're making money, but in my experience, I've never really made money doing that. Why is that?
Okay, first question. Why not buy the call as opposed to write the call, right? So the reason why buying the call is more popular is because when you're buying the call, you can get 100% return, 20% return,
Yeah,
5 times, 10 times return. And you can buy a call. Let's say this Tesla 19. So let's say you buy this call for 1975, which is 1,900. Let's say $2,000. Okay,
yeah.
I'll write it down so I can take a note on this. So you spend $2,000 to buy a call, and this is the 370. If Tesla would go to 400, I think it'll break 414. Write that down somewhere.
I have it in my notes from yesterday. That's the all-time high that it needs to break.
Yeah, then it'll go higher. But let's say it goes to 400. What happens is, and it could go to flop to 400. You see Tesla jumping all around, right?
Yeah, it's got like a huge
So
wave.
this stock will go up 50 points, 48 points to 400. This call for the 370 will be worth how much? You know,
I don't right. I don't know what that would be worth then. I just can tell you what it's worth now. I don't know how to calculate that.
it'll be worth 30 because the distance between the 370 and the 400 is 30 points. So it'll go to $3,000, which is a 33% gain. You understand?
Right, right.
So we're only getting 5%, and they're going to get a 33% gain. They're going to go from 2,000 to 3,000.
Yeah.
We're getting a 5% return. See that?
Yes.
Now, why is it that I say 3,000? Because intrinsic value, real cash value, the value of an option is going to be how much is in the money. And if the stock is 400, a 370 is 30 points in the money, $3,000.
Yeah.
Did that sink in?
Yeah. That makes sense.
If I own a 200 Tesla call, which there are people out there who have that, maybe they bought it a while back.
Yeah.
That's going to be worth 152 points in the
Yeah.
money. That's $15,000 right there. Call. That's half the share price. If I own a 350 call Tesla, it really has $2.50 intrinsic value. At the expiration, a 350 call today, at the expiration today, is worth $2.50, $250.
Yeah.
Now, what'll happen is, if you buy a call, this 370 call, Tesla pops at 400, let's say by next week, it's not only going to be worth 30, it's going to be worth more, probably like 45, because it has time value also. So there's what's called an extrinsic value.
Yes.
Extrinsic value is hype, is time value, is I'm going to bet that because we have a month, it'll go higher, and I'm going to pay a little bit more premium for this call, even though it's in the money by X dollars. I'm going to pay a little bit more on the call because I did sort of have some extrinsic value, and it's probably going to end up being 4,500, not only 3,000. But if at the expiration it's 4,000, it's 400, that call will be 3,000. But if it's before expiration, it'll be higher because there's time and there's hype, and it has time to go higher. So in all intents and purposes, when someone buys that 370 call for Tesla, it could be going to 4,500, which is 45 points. So they could be actually doubling or tripling their money, 100%, 200% return in reality. And that's why they buy. They're trying to get a high return. It's a risky scenario because why? Because the stock goes down instead, and we know it can go down.
Yeah.
Instead of making 33%, 100%, 200%, they're going to lose that much. Okay, as much as it can go up, it can go down. They're going to lose, 50%. Like you said, it went down half. That's a good point. It went down 50%, at least 50% of their option if the stock goes the wrong way. And look at us. Look at the cover call writers. We have the shares. We're looking at gaining 5% a month. Okay, as a goal. Maybe 3%. On another stock like Netflix or Chipotle, or maybe Apple 2.5%, even less, because it's more safe, because it's more fat and stable. Okay, IONQ stock is more risky, 10%. Okay,
Right.
but meanwhile, we have the shares. We're going to look at a share loss of 10%, 20% share loss. No big. Why? Because we get that back in a couple cover calls. So it's a defensive play. We're getting less money taking a defensive play. Can you give me 1 second?
Yeah.
Did that sink in?
Yeah. I guess I get the risk management piece is probably the most important part of what you're saying. Um,
Let me say it a different way. You ever play poker?
yeah, I'm not very good.
But have you played at a casino?
No, just with friends.
Okay. I don't know if I can show the example, but when you play poker, there's two sides. The house collects like a couple dollars every hand. Okay, they put it in the table like this. Okay, the players can double their money a hand or lose all the money in their hand. Correct?
Yeah.
So those option writers, those option buyers are like poker players. They try to double their money, triple their money, go all in, But the house is collecting just a few bucks every time, just bringing in that dough. So we're like the house in the casino.
Yeah.
We're getting small money every time, every trade, and with a low risk. Now the house can still lose, right? But long term, probably not, because we have an advantage. We have a lot
Yeah.
of advantages. Like if you went to play blackjack or craps, you could knock over the house by a few grand, you know.
Yeah.
But over the course of a long term, a lot of players, since the house has an advantage in every game, house is going to win at a casino mathematically, right? So we're like the house at a casino. We're getting a small amount of money over safely over monthly.
Yeah.
And that's why I say write 10 cover calls a year, because now you're adding up this 10, 20, 30, 40, 50, 60, or if it's 5, 10, 15, 20, even if it's 3%, 3, 6, 9, 12, collectively that's going to add up and get to the point where the share fluctuation is not going to matter. We're going to outperform that share fluctuation.
Yeah.
We're going to outperform the share loss, whatever share loss you get. That gets you to the cash cow position where all those cover calls added up equals 100% of your investment. On paper, can't lose money.
Yeah. Well, just to wrap that question up, right? Like I know this isn't what we are teaching and this isn't the philosophy you're teaching, but just to have an understanding, because it's like a burning thought in my mind. Like I don't understand the people that do it successfully, the ones that are like buying calls and puts without doing covered calls and puts. What what the heck are they doing if they're successful? Do you know what it is? I'm not saying like I want to do that or I want to learn that. I'm just trying to figure out like how do the people that do that successfully get it right? Like what are they looking at differently? Or is it just that they continue to keep getting lucky, which I don't know if that's a real answer, but maybe it is.
So let me first start off by saying we're not going to focus on that in our training,
Yeah, yeah, I
because
understand.
that's not part of that is part of the training, but we're not going to focus on it as a main income. Okay, but the way they're successful is that, first of all, you might think that their whole account is for call options, but the successful ones only have like 5 or 10% of their whole account to that one call option.
I see.
So they do have dividends, they do have cover calls, they do have other long-term share growth stocks as a
Got it.
foundation, and they're only going to put at risk, high risk, 5, 10% of their whole account.
Got it.
So when they lose, no big, they can do it again. When they win, they'll probably celebrate. Look, I got 200% return on my Tesla call. It went from 22,000 to 4,500. I'm gonna go party tonight and
Right.
blow $3,000.
And we on the internet only get to see those wins, not the
Yes,
losses,
yes. They
obviously.
don't want to tell you when they lose.
Right.
Now, an important lesson for you starting out is: do you know that when you lose, it affects you more than when you win?
Oh
When
yeah,
you
of
lose,
course.
it's worse for you than it's good when you win. Does that make sense? If I saying that right?
I've felt it. I can know from experience.
Let's do some math, shall we?
Yes.
You have 100K. Okay. Now let's give me a 10% return. What are you at?
10,000, 110,000 total.
So 100K plus 10, 110. Now let's lose 10%. What are we at?
From the 110,
Yeah.
then you're back at so 110,000 times point 0.1. So you're back at 100K.
No, you're not.
Wait a second.
Start again. 110K, 110K, and you lose 10%.
So 10% of 110,000 is 11,000.
There you go.
And
Now you're doing it right. Now, and what's the result?
And minus 11,000, you'll actually be at 99. You're right, 100,000 less than your original capital.
Now let's do a 20% move, shall we? Oh, by the way, What happened to the $1,000? You gained
Gone.
10%, lost 10%. Where did it go?
It's gone.
Let's do 20%. 100K plus 20%. We're at 120, right?
Yeah, point
Now
two.
let's lose 20%. Where we at?
So we got 120. So, oops.
Minus 20%.
$24,000 subtracted from 120K. You're looking at something like $96,000.
So you gained 20%. You lost 20% in trade number 2, and you're out 4K.
Yeah.
Let's do a 50% loss. Let's do a 50% gain and 50% loss. 100K plus 50K equals 150, correct?
Yeah.
Let's do a 50% loss.
Yeah. So now you're just subtracting 75K from that. You're half. You're at 75K.
You lost 25K from the start. You gained 50. You lost 50. Do you see how the loss affects you more?
Yes.
Now, if your first trade is losing 50, let's do that. 100K. First trade losing 50 is
50.
50K. Now you gain 50%. What are you at?
75.
Doesn't matter what order. The losses affect you more. Understand?
Makes sense.
So you
Yeah.
have to control. You have to control your lot. You can't trade blows with the market. You can't guess. You can't do a 50-50. It's not going to work. You're going to be headed towards oblivion. So you have to have what's called, write this down, at high accuracy. High accuracy. Write this down: 7 wins to 3 losses plus. That means out of 10 trades, you got to have 7 trades that are going to be successful to 3 losses. And if you don't have that, you're not going to be successful. You can't even do a 6-4. Do a 6-4, you're going to end up losing.
Yeah.
Now, can I tell you my experience with the cover calls over the
Yes.
over the years? 9-1. Have a decent stock, got a decent cover call, stay with it. 9-1. So there you will have that loss. Okay. You will have that stock that just gets slammed, it doesn't come back, and now you bought it at 50, it's down to 9, and it's not coming back, and the cover call is crappy, and
You
you're
have a
gonna walk
90.
hang on. You're
Yeah.
gonna walk away with a loss. So there will be that example, but the idea is, you're gonna pick better stocks, you're gonna take your loss, move on, pick better stocks, and on the whole, you'll have a 9-1 record on your wins losses.
Got it.
Now on buying calls, your win loss is going to be less because, buying a call for Tesla, I don't care what strategy you're using, there's going to be, if you were to have 9 wins, 1 loss, I'd be shocked as hell because there's just, you're relying on the stock to move a certain way. For example, you buy a call, you need the stock to move up to make money. When you write a call, you don't have to have the stock to move up. There's three things what's going to happen. Stock's going to go up, stock's going to stay the same price, stock's going to move down. When you sell a call, the stock can basically maintain the same price or move up. Either way, you're going to win. Okay. When you buy a call, if the stock stays the same price, you're going to lose because of time decay. You only win on the buying the call, the stock goes up. So with the 3 different requirements 3 different results that are going to happen, that can happen. If you sell a call, you're going to win on 2 of them. You're going to win when the stock goes up or stays the same price.
Yeah.
When you buy a call, you're going to lose on 2 results. You'll lose if the stock stays the same price or if it goes down. You're only going to win if it goes up.
Got it.
Make sense?
Absolutely.
So I'm giving you the advantage. I'm showing you advantages. 1, pick great stocks as an advantage. 2, selling the call, or we call writing the call, instead of buying the call. That's another advantage because you have the advantage of having that cash up front. And 2 results of the 3, you're going to win. Whereas if you buy the call, you only have 1 result of the 3 you're going to win. Stock has to go in your favor. And you'll see. You got to apply these trades.
And I also noticed that in this covered call strategy, you have never really mentioned from any of the content I've seen of yours about the Greeks because it really doesn't apply versus if you were just buying a call or a put, then those things like, the delta rate and the decays and stuff, they're important for you to know, like how much volatility there is and such. But in this covered call, once I've gotten my premium, I'm just like, whatever, like if this shit goes against the person who bought it, I don't care. I still made the money. It almost sounds like the Greeks don't matter as much on the covered calls versus the other strategies.
Yeah, you asked me like last night about Bollinger Bands. I don't really use Bollinger Bands. I don't need to teach you that. I'll show you how I look at that and what sense it makes, but it's not part of the training.
Yeah.
The deltas, I'm sorry, the Greeks, I use delta because I want to know on the option what's the value of the option versus the shares, and that's the delta. The beta, I use beta to show that how much how volatile is the stock. That's the beta. Like low beta is like Philip Morris, PM. High beta is like Tesla or IONQ. So we know that those are more risky. But for the most part, the Greeks aren't really that important. You're correct.
Makes sense. Makes sense.
There's all kinds of technical analysis and also fundamental analysis that people will do. People do different kind of things. I'll show you different things. Matter of fact, if you look at what's your account of fidelity, if you pull up the stock on Tesla, for example, you'll have like five different on the website. You'll have five different broker houses rating each stock A, B, C, 1 star, 2 star, 3 stars,
Yep.
and they
Yep.
all have a different way to rate.
Yeah. Yeah.
One has a Tesla has an F, and it has 3 stars, and it has an A. What has it an F and A?
Yeah.
You know,
Analysts are all over.
because the analysts are doing different stuff. So I'm going to show you my way, apply my method, ignore the rest of the stuff. Don't read books. Don't look at someone else. Don't look at other people, because I want you to focus and learn it my way. That way you can get the results that I'm showing you.
Yeah.
So don't like think you can like read up on this and learn. I just want you to learn what I'm showing you. That's all you need to learn. Don't
I'm
worry
here
about
for
it.
it.
It's not. Don't make it complicated. It's not complicated. And if you can apply these trades, let's say we do two sessions a week. You can apply these trades and do your homework, rewrite your notes, apply these trades, and then watch the video. Then I think that would be sufficient. But sometimes, you'll see yourself. If you start slacking, you'll see if you start slacking. We're going to be in a new session, and we need to know what happened in the last session so we don't repeat ourselves and we don't waste time. And we go to the next thing. You need to know division and multiplication before we do algebra. You need to know multiplication before we go into percentages. So it's a gradient scale. So make
Makes
sure
sense.
you review, and if you have any questions, definitely bring them up, because if you pass on a subject and you have questions, that's going to bother your mind, and you're not going to be able to learn the new stuff until your questions are answered. Make sure you bring all the questions to me, or I'll knock them out every session or
Sounds
before.
sounds good. Yeah, I'll text you if I have questions. Is it a good use of the last sort of 10 minutes if we stop recording and we go through like some of the open positions I have and one of the trade ideas that we kind of talked about, but I'm considering finding a way to execute the Tesla trade tomorrow. But is it okay if we like do like a practical on the screen share or
Hold that thought. Okay, just for the recording, I want to get on a couple of things for the first session.
yeah, yeah,
Okay.
let's do that. That's fine.
Couple principles. One is there's 12 criteria for stock selection.
Yeah, let's go through.
Ideally, you want to use all 12, but most stocks will have 8, 7, 6. The first one I think is volume. Is the best one, volume. So you want to have high volume, and 2 million a day is ideal. 2 million a day average. And that's because that indicates more investors, more traders that are going to buy that stock when it dips. That's going to save your ass. Plain and simple.
Yeah.
Questions on that?
Nope.
Next one is 10-year chart. And you can also do a 5-year, but I like the 10-year better. The stock's been going for 10 years. It's showing staying power. It's showing tried and true. It has a history of where the stocks went, and ideally goes from the bottom left to the top right, which means it's gone up. It had to at least maintain price or increase in price in 10 years. If it's gone down in 10 years, big red flag. If it's going the wrong way, it's going from the top left to the bottom right, big red flag. And people will look at this and they'll argue with you. They'll say, well, hey, maybe it's just a better price now. No, a stock needs to make money over time. There's no 10-year chart where Microsoft lost money. So look at that as a precursor to what it's going to do in the next 10 years. Not exactly, but a guideline for the next 10 years.
Yeah.
Questions? And then
Makes
the last one is PE. I like to have PE, which is price earnings, but really it just means profit or not profit. Has a PE of 20, it's fairly valued. Has a PE of 30, it's a little higher value. It has a PE of 100, it's a hot, way over a high value, but being so hot, it does show a profit. And a positive PE is better than a dash or a negative or nothing, which means they don't make money, which means they're losing money, which a lot of stocks do lose money. And I want you to know that if you're investing in a stock that's either making money or losing money. And furthermore, if they consistently have the PE, meaning that some stocks will lose their PE on this earnings and then get their PE back and then lose their PE again, this is also nonsense. That's a red flag. They need to have consistent PE. So you're investing in criteria. You're a shrewd stock selector, okay? And let me just mention 3 more for next week, but I'll just say them briefly. Dividend. If they can pay a dividend, it's better. You get a check mark. Cover call. If they can pay a cover call a month for 30 days, 3 to 5% return, it gets a check mark. Stocks that don't have an option chain can't do a cover call. Stocks that have a 1% return a month or 2% return a month on the cover call don't get the check mark. Okay. CC. Questions?
No, I got 1, 2, 3, 4, 5.
And then we'll do one more. We'll do one more. Stock splits. SP. This is, what we are. I'll tell you what we are. We're contrarians because a lot of this stuff they're not going to teach you in seminars in school and business. I'm going with things that I know in my experience at work. Stocks that have stock splits are great. A true successful stock will have stock splits. And if it has one stock split at least, it's bound to have more stock splits. So a stock that has stock splits, that gets a check mark. And a lot of reasons, stock splits, generally the criteria is this. Stock is at $50, it goes up and up and up and up, 150, 200, 300. Oh, look, it's higher price. Let's split our shares back down to 150, 2 for 1. Now you get double shares. Stock is split in half. So it splits the price. At that point, you didn't make any money. But what happens is, tend to go right back up to the old price, back up to 300, and then you've doubled your money. So it's a continual thing. And again, look at these stocks: Walmart, Microsoft, Coca-Cola, 5 stock splits, 10 stock splits, Starbucks, 7 stock splits. So over time, stock splits are going to give you what I call exponential return. Chipotle, 50 for 1. Now Chipotle going down from 3,000 to 60. What's going to happen? So we go right back up, 100, 200. Okay, unless it has some serious major problems, unless it's just 1 of 9 return, which barely happens, it's going to go up and do great. Questions?
Are you waiting to tell the other 6 at another time, or you want to just tell me so I can?
Yeah. I'll get to them next session.
Okay, that's fine.
So at least we got some basic principles here.
Yep.
And then let me just say this for the first session. I want you to have some diversification. I want you to have a few dividend stocks, some cover call stocks, and only a small percentage doing like trading, like when you buy a call, for example, or do an option trade, for example. So I want you to balance your account. I don't want you to have all cover calls. I don't want you to have all want you to have some dividends, and I don't want to have all options either, you know. But I will show you some option trades when you buy the option and sell option. I just want to do it later on, and for the small percentage of your account, 5%, 10% of your account.
Got it.
That's safe. Because why? Because if you have a 40% loss, you have a 50% loss, it's so hard to come back from that. If you have 100K and you have 50% loss, you need 100% return to get it back. Make sense?
Yes.
So here's, write this down. Control your losses. Play great defense. Lower risk. These are all things we need to consider. Yeah, we can, if you, any questions so far?
I'm good. Yeah, I wanted to just spend.
Let's conclude, and then we can look at your portfolio.
Perfect. This was wonderful. Thank you.
Get some gold nuggets.
Absolutely. Yes.
All right, I'm gonna stop the recording.